Hi there, welcome to Kneppy Invest. Finally getting into the next video in this particular series, the best performed ASX small companies during the period between May 2013 and May 2023. I started this research in May 2023, and the first video series I did in this particular area was looking at the best performed ASX companies with a markup above $1 billion. Now I'm looking at those companies that performed really well over the past 10 years with a markup below $1 billion, hence small companies. I've already done 3 videos in this particular series featuring those companies that came in between 25th and 16. Also had a look at the honorable mentions and the worst performed companies. Now, the whole reason I'm doing not only this series, but also the previous series is I wanted to find similar characteristics among these best performed companies. And I'll let you decide what these characteristics might be. And I would advise have a look at also the other videos I've done, not only in this series, but also that original series of looking at those best performed companies on the ASX with a markup above $1 billion. And to me, to be fair with you, and to be honest, the characteristics or the similar characteristics among all these companies is fairly evident. Now, before we have a look at these 5 companies that came in between 15th and 11th. And it's funny, when I had a look at these 5 companies, unlike my previous video, we actually owned 4 of those companies and I know all 5 of those companies quite well. These 5 companies I know much less about. In fact, one of these companies I knew nothing about. In fact, that company that came in number 11th, I actually had to do a bit of research just to know what that company does. So even though some of these companies has performed really, really well between 2013 and 2023, I still did not know what some of those companies did. So let's get into it. But before we have a look at these 5 companies, a few of the rules I put in place in drawing up this list of best performed ASX small companies. The first obvious rule is all these companies, as of May 31st, 2023, had a markup below $1 billion. Now, as I'm speaking, on March 5th, 2024, some of these companies within this video series, maybe not within this particular group of 5 companies, have a markup now well above $1 billion. Now, some of the other rules I had in place to draw up this list, revenue making, so no story stocks. So I wanted these companies to be real companies generating revenue, selling a product or a service, no mining companies. In fact, I was thinking of doing another series just looking at mining companies. So I wanted to separate non-mining companies and mining companies simply because, in my opinion, mining companies are not the sort of companies you want to own for the long term. They're more of a short-term hold and just riding the trend, because mining companies and mining tends to be quite cyclical. And I also looked at total returns. So I not only looked at share price appreciation, also included dividends, which is more important for more mature, bigger companies. But for some of these companies, they are dividend paying. So I wanted to include dividends because you should always include dividends when you're looking at total returns for a company you own. Now, something very important here is just because these companies performed really well between May 2013 and May 2023 doesn't necessarily mean these companies are going to perform really well over the next 10 years. In fact, some of these companies might perform quite poorly over the next 10 years because the last 10 years was their time to shine, and now it's not their time to shine. And maybe some of those companies that did not perform well over the last 10 years will perform steadily over the next 10 years. So just because some of these companies have popped up in this list doesn't necessarily mean they are good investments right now. Coming in at number 15, we have Globe International. I do know a little bit about this company, not a lot. I've never thought about owning shares in this company. I've never owned shares in this company. And the only thing I do know is this company has something to do with skating. So they do sell footwear, clothing, and they do cater to the skating crowd. In fact, if you go to the website, on their homepage, they do have a skater going down a railing of some stairs. And they do have a quote from Stephen Hill, who must be a skater. If we could dedicate our lives to skating, why not? Now, this company has grown quite significantly over the past 10 years. The market cap has grown from 15 million to 95 million as of May 31st, 2023. Now the market cap of Globe International is around 140 million. Now, even though the market has grown a lot, shares in issue have remained the same at 41.5 million. That is one thing I like to look at for companies, but just because a company might increase the shares in issue is not necessarily a bad thing. But Globe International has not raised any money over the past 10 years. So you'd say this company has been profitable during that period. Now, revenue per share growth, 11.6% per year. Gross margins at 46.1. Return equity, 16.3. Exactly what I want to see. I want to see return equity above 10. And the analyzed total return of Globe International is 25.2% per year. And if you've been a shareholder of this company since 2013, you're probably a very happy shareholder right now. Now, earnings per share and dividend growth are not applicable. More than likely, this company has not been paying dividends over the past 10 years, and earnings per share back in 2013 were actually negative for 1 year, if I remember correctly. But impressive growth for Globe International. Looks like they're doing well. Share price has been or was under pressure for a period of time back in 2022, 2023, after a period of time when the share price actually absolutely took off in 2021. So in fact, instead of talking about the chart, let's have a look at the chart right now. Yeah, I don't know why I was talking about the chart instead of just showing you the chart. So it's quite obvious that Globe International had a bit of a hype period back in 2021. In fact, the share price of this company went from about $1 in the middle of 2020 all the way up to $7.50, a seven-bagger in a very short period of time. And one way, probably should mention, one way to play some of these companies is just to trade them. You don't have to hold them for the long period, because you'll notice a similar theme in all these charts. There are periods of time where these companies are beloved by the market, sort of a market darling, and other periods of time when it's complete opposite. So for Globe International, this company was a market darling between, we'll say, May, June 2020, all the way through to late 2021. So over about a 15-month period, the share price of this company increased sevenfold. And then from September, October 2021, all the way through to September 2023, so over about a 2-year period, the share price of this company fell from $7.50 all the way back down to $2. And now it looks like it's recovering. But if you just ignore that period between 2020 and 2023 and go all the way back to 2013, the share price of this company has increased significantly. The other thing to note is the liquidity of this company has also increased significantly as well. And that's something else to point out, is sometimes you'll listen to an expert and they say, don't buy companies that are illiquid because you can't get out. In fact, they'll call it a lobster pot. That's absolutely ridiculous if you like the long-term potential of the company, because over time, if that company that is liquidly traded, if that company can grow and expand, eventually that liquidity will improve over time. And instead of being hard to get out of, it's quite easy to get out of. And a perfect example of this was Altium. Back about 10 to 12 years ago, that company was illiquidly traded and really hard to get out of, really hard to get into as well, because it was illiquidly traded. But right now, well, I've sold out of Altium because there is a takeover bid for that company, but easy to get in, easy to get out, because that liquidity has improved over time. And some of these companies, you'll see that. In fact, the last company I'll show you, the company I know nothing about, you definitely see a massive increase in liquidity back in 2014, 2015. Coming in at number 14, we have Premium. Now, this is a company I have owned in the past, sort of like an investment advice company. And to be honest with you, back when I invested in this company back in 2013 or 14, one of the reasons I invested in Premium is simply because of the potential growth, and I thought it was better value than some of their competitors. Right now, I'm on the completely different fence. In fact, I think some of this company's competitors, not investors, competitors actually much better value and have greater potential of growth in the future. Now, that does not mean Premium is not a potentially high quality company in the future, but it has been going through some troubles in the past year or so. And so, in fact, if I did this exercise and I looked at returns between 2014 and 2024 right now, Premium might not make this list. But Revenue per share growth of 13.7% per year. That's exactly what you want to see. Nice growth. Earnings per share growth of 14.4%. Now, back 10 years ago, this company did not have a dividend. In fact, they were barely profitable. Gross margins 42.6. I probably would like return on equity to be a little bit higher. And if I remember correctly, I have done a little bit of research on this company, not a lot. Return on equity has been higher in the past 5 years. And that can be a concerning sign if you do see return on equity actually dropping through time. And the company has given their shareholders over the 10-year period between 2013 and 2023 a nice 25.2% analyzed return. Now, the market cap of this company did increase from 23 million to 311 million, which you might think, well, that's a fairly big jump in markup. And the reason why this company has the same returns as Global International, even though the markup has significantly increased by a greater rate than Global International, is because this company has had a few capital raisings in the past, and that's why the shares on issue have increased from 350 million to 510 million. Now let's have a look at the weekly chart for premium going back to 2013. So this is almost an 11-year period of time. And just like Globe International, you'll see periods of time when this company was a market darling. And typically those periods of time don't last all too long, maybe a 2 to 3 year period. And then sentiment can change quite quickly and violently. In fact, we saw that with premium back in late 2021, early 2022. So if you just look at this 11-year period and just held shares in this company, you've done fairly well over this period of time. But if you traded, you could have done really, really well. Now, I did own premium way back in 2014 when the share price was in this uptrend. And that uptrend actually lasted for about 5 years or so. And the share price of premium went all the way from about 10 cents, or maybe even below 10 cents, all the way up to a share price high of about $1.20 in the middle of 2018. And then the share price fell from $1.20 all the way down to about 20 cents over a 2-year period. And the bottom was during the COVID-19 financial panic in March 2020. So a 6-fold decrease in share price. Yeah, 6-fold decrease in share price over a 2-year period. And then just like Globe International, in fact, just like many other companies on the ASX, there was a 2-year, we'll say 18-month, 2-year period when this company was a market darling. And maybe every single company on the ASX was a market darling. And the share price of premium increased from 20 cents all the way to a high of $1.60. So an 8-bagger over a 2-year period. Yeah, about a 2-year period, or just under a 2-year period. So you would have done really well if you just held premium shares during that period and just waited for a sentiment to shift. And then the sentiment shifted violently from positive to negative, and the share price of premium has fallen from $1.60 all the way back down to about 40 cents. So the share price has decreased 75% since its highs we saw back in, about 2 years ago. Coming in at number 13, we have GR Engineering, another company I've never owned. In fact, I am now having a look at their website just to see what this company does. It says they're a leading engineering consulting and contracting company that specializes in providing high-quality engineering design and construction services to the mining and mineral processing industries. This company has performed quite well over the past 10 years, even though I'll probably say this company would probably be more cyclical than other companies on this particular list. But revenue per share growth, 12.7% per year. Earnings per share growth, the same as revenue per share growth at 12.7%. This company has been a dividend-paying company over the past 10 years, and dividends have been growing at 3.2% per year. Gross margins of 43.7%. A really impressive return on equity at 31.9%. I actually had a look at the return on equity history of this company, and this company seems to have had a high return on equity over the past 5 or 10 years, and an analyzed total return of 25.6% per year. So been holding this company over the past 10 years, even though the share price, just like other companies on this, have been going up and down violently at times, you've been very happy with that analyzed total return. Markup of GR Engineering has increased from 63 million to 320 million, and shares on issue have been relatively flat, a slight increase from 150 to 162 million. So let's have a look at the chart for GR Engineering, and we can see how the share price of this company has been quite volatile, and that does point out that there could be some cyclicality to this company. and possibly geoengineering at the top of the cycle. So you notice big swings in the share price, but typically when you do see negative or positive sentiment in this company, that sentiment lasts for about 3 to 4 years. So there have been 3 trends within this 10 or 11-year period. In fact, the share price low of geoengineering was way back in June 2013. And that's one of the reasons why this company has had really good returns from May 2013 all the way through to May 2023, because I'm looking at the low or just timing. So I picked the right time for this company and picked the low and almost picked the high as well in May 2023. But 3 obvious trends in the share price of this company. And I think that does point out to possible some cyclicality in this company. The first trend was from June 2013 all the way through to the middle of 2016. Share price during that period rose from 40 cents all the way up to $2. So it's on about 5-bagger during that period. And then the next trend was a downtrend, and that downtrend lasted for about 4 years. From June 2016 to June 2020, share price fell from $2 all the way back down to 60 cents. So we're talking about a 70% drop in share price over a 3 to 4 year period. And then the next trend in the share price is right now. And maybe we are moving towards the end of this particular trend. This particular trend started in the middle of 2020. Share price was 60 cents. And now the share price is around about or just under $2.40. So a nice 4-bagger over the past 3.5 years. And just by looking at the weekly chart here, you notice the share price is still in an uptrend, but it really has to get above $2.50 for me to confirm the share price is still an uptrend, because $2.50 is a really strong, significant resistance level for this company. That was a high in the share price back in June 2022, and the share price has yet to get above that high. So possibly the top of the trend for geoengineering. Don't know, but maybe just is right now. Coming in number 12, we have Probiotic, a company I did own for a while, and then I recently sold out when there was a takeover bid for this company. Not at a big premium, but the premium was enough for me to sell out. And I do have a rule, not an absolute rule, but I do have a rule. When there is a takeover bid for a company I do own, I lock in the profits almost immediately. Now, you might say, then I can't take advantage of any bidding war for that company. But bidding wars are much rarer than takeover bids failing. And when a takeover bid fails, the company share price typically drops a lot. And sometimes I can take advantage of that. I took advantage of that with EOL, and I've taken advantage of other companies when the takeover bid fails and the share price drops. And in fact, that happens way more than bidding wars. Anyway, so that's the reason why I usually lock in profits when a company or there is a takeover bid for a company I own. Now, Probiotic manufactures and sells health products, that sort of thing. And they've done a fairly good job over the past 10 years, as you can see by some of the numbers. Now, revenue per share growth of 8.2% per year, earnings per share growth of 9.9%. I probably would prefer those to be above 10%, but 8.2 and 9.9% are okay. Now, dividend growth not applicable because this company has not been paying a dividend to their shareholders over the past 10 years. They are a dividend paying company now. Gross margins of 35.9. Return on equity, I probably would prefer that to be a little bit higher, but I am nitpicking right here now by 13.6. So I probably would like that to be above 15. But you can't complain with an analyzed total return of 26.1% per year. And 10 years ago, this company only had a market cap of $17 million. At the end of May 2023, the market cap was now, at that point in time, $205 million. And the company has raised a few has done a few capital raisings. Shares on issue have increased from 53 million to 81 million. Now to Probiotics weekly chart. And to be honest with you, this is probably the more intriguing chart out of all the charts I'll show you today, because unlike some of the other charts, you don't see a wild swings in the share price. You don't see these transitions from a really positive sentiment to really negative sentiment. In fact, during this 11-year period, there's no significant periods where you do see absolute negative sentiment. Maybe back in 2014, but to be honest with you, back then I had no idea this company existed. Now, from 2013 all the way through to 2017, share price of this company is just going sideways. And then the share price of this company broke out in the middle of 2017, and we started to see volume increase also. And the share price of Probiotic increased from about 40 cents or 50 cents when it broke out, all the way to $2.50 in early 2020, just before the COVID-19 financial panic. So this company was a five-bagger over about a 3-year period. And even though COVID-19 was just a blip on this company's chart, you can barely see it. You can just see it slightly here. The share price has not got lower than that. It briefly sort of tested those lows back towards the end of 2020, and there was a really strong resistance level for this company at those highs back in early 2020 at $2.50. So you can just see the share price just grinding higher. So this is one of those companies I was owning, just watching the share price grind higher. And then the share price broke out in the middle of 2023, and I thought, oh, this is great. Share price is finally breaking out. And then for some reason, the share price collapsed towards the end of 2023. And then that was that sneaky takeover bid. Whoever decided to buy this company saw the share price collapse for over about maybe a 2-month period, and they put in this opportunistic takeover bid. Share price increased to $2.90. And since that takeover bid, which was about 2 months ago, share price has slowly fallen. And right now the share price is at $2.75, which is actually lower than when I sold. So maybe the market is a little bit concerned this takeover bid might not be happening. I have no idea because I have not had a look at Probiotic since I sold out. Coming in at number 11 is a company I know nothing about. In fact, I saw this company and went, I have no idea what this company does. Is it a mining services company? I have no idea. And I had a look online, and this is what they say on their website. It is an ASX listed company. Of course it is, because it's featured in this particular video, focusing on providing quality and affordable accommodation for seniors and disability pensioners. So what they do is quite obvious in that one line, although is focusing spelt with 2 S's? That's interesting. That's interesting. I'm not an English major. It is. Well, actually, it says focusing or focusing. It can either be spelt with 2 S's or 1 S. And that's really interesting. I did not know that. In fact, according to this, focusing with 2 S's has been phased out. Focusing with 1 S is acceptable and used variation. So Eureka Group Holdings, you might have to change your website. And instead of spelling focusing with 2 S's, maybe to show you're not funny that is, you have to spell focusing with 1 S. So that's interesting, something I did not know until right now. How do you spell focusing in Australia? In Australian English, the more widely accepted spelling is a single letter version. There you go. Anyway, so Eureka Group Holdings, that's what they do. And to be honest with you, as soon as I saw what they do, it's understandable why I have very little interest in this company, why I have never done any research, is because in that sort of sector, that area, I have no interest in investing in that area. Anyway, let's have a look at how this company has performed over the past 10 years. Coming in number 11, it must have performed fairly well. Had a look at the revenue per share growth, and I was like, 0.5% per year revenue per share growth. Earnings per share growth, however, 54.9%. So there is a discrepancy between revenue per share growth and earnings per share growth. So this company must have really increased the margins over the past 10 years. Now, this company didn't pay a dividend for the longest time, but has started paying dividends about 4 or 5 years ago. So that dividend growth is not applicable. Gross margins are 46.1%. Return on equity 9.9. I'm pretty sure that has been increasing. And an analyzed total return of 26.6% per year. So even though I am complaining about this company, particularly with their spelling or focusing, and not my more favored area of investing in, that's a nice analyzed total return of 26.6. You always going to accept that sort of return. Markup has increased from $3 million back in 2013 to $142 million in May 2023. Now, if this company didn't raise any equity or didn't do any capital raisings, that would be a massive increase. In fact, this company would have come in number 1. But this company did do quite a few capital raisings, and shares on issue in Eureka Group Holdings has increased from 80 million back in 2013 to 301 million. So almost 4-fold increase just in the shares on issue. So just because a company has increased the shares on issue is not necessarily a bad thing for shareholders. In fact, what this company might have done with that increase in cash is they could have made some really wise investments, and those wise investments could have been helpful to the shareholders. And that's why this company has given their shareholders a 26.6% return over the past 10 years, and why the market cap of this company has increased from 3 million to 142 million. Now let's have a look at Eureka Group's weekly chart. And this is a really interesting chart, very dissimilar to Probiotic, whose share price almost went up in a straight, not a straight line, but there was a definite uptrend. There is no definite uptrend when you look at Eureka Group holdings. In fact, this is fairly similar to some of those other charts, when this is more like a trading stock. You want to be trading this company, not holding it for the long term. Although, if you bought shares in this company back in 2013, you'd probably be a pretty happy shareholder. Now, back in 2013, when the market was 3 million, I'm not sure why you would have bought shares in this company. In fact, back then, highly illiquid. In fact, I looked at the longer time period here, going back to 2009, and there were long periods of time when no shares in this company were traded. And then for some reason, the market absolutely fell in love with this company in 2014. And from 2014 all the way through to middle of 2016, so it's on about a 2.5 year period, the share price of this company went from about 2 cents all the way up to 80 cents. This was a 40 bagger over a 2 year period. And you would have been loving life if you're a shareholder of this company back then. But that was a share price high for Eureka Group Holdings during this 11-year period. It was in the middle of 2016. And then something happened to this company, something negative happened to this company at the start of 2017, because you see, share price absolutely fell off a cliff. Share price went from about 70 cents all the way down to about 35 cents in about 3 or 4 weeks. So obviously the company released some negative announcements, and the share price kept on falling for the next 2 years. And in fact, the share price fell from a high of 80 cents all the way down to 25 cents. But you can see the share price just consolidating. It didn't fall below 25 cents. In fact, 25 cents was a really strong support level for this company. But it took a while for this company to move back into an uptrend. There was a brief period of time when the share price looked like it was taking off. Then we went into COVID-19, share price fell back down to about 25 cents. And then the share price of this company moved into an uptrend during that hype period where everyone loved the equity markets. Late 2020 into 2021, share price of Eureka rose from about 25 cents to a high of 72.5 cents. But since then, share price of this company has been under strain. However, if you look at the last few weeks, share price looks like it wants to break out from another consolidation period. And that consolidation period, or the bottom of that consolidation period range, is around about 40 to 42.5 cents. So that's all I have for this look at those companies that performed fairly well during the 10-year period between May 2013 and May 2023. These companies came in between 15th and 11th, and all these companies gave their shareholders who held on to their shares over this 10-year period nice returns of greater than 25% per year. And to be honest with you, you will never complain if a company provides you with those sort of returns. If you have any questions, any thoughts, just leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.